Hello, everyone, and welcome to Schwab Coaching. My name is Cameron May. I'm a Senior Manager of Trading and Derivatives Education here at Schwab, and this is Getting Started with Options. And today, we're going to a viewer request. I was going through my YouTube comments section recently, and someone asked, Cameron, I've heard about this strategy known as a synthetic stock. Sounds weird. Can I really use options to replace stock ownership? What are the pros and the cons? I want to get into that discussion today. It's not a terribly complicated strategy, just two different options involved. We'll talk about how it's constructed and how it might be preferred by some traders in place of stock ownership. We're actually replacing an example trade of a synthetic stock today. A lot to cover. Before I can get to any of that, though, let me first of all say hello to all of you out there watching via YouTube. Great to see so many familiar names. I see a lot of new names out there as well. So hello there, JB52, Kendra, Josh, Ingrid, Mighty Mouse, Janelle, Scott, GS, Ken, Jack, Richard, Tatiana, Ricebird, on and on and on that list goes. So for those of you who are among our returning veterans, welcome back. I definitely always appreciate your attendance and your contributions to these discussions. To the hundreds of new watchers today, I want to welcome you as well. If this is your first time here, fabulous. It's so good to have you here. I'm going to go to a pace that hopefully everybody can follow. I know this is going to be a new strategy to a lot of you out there, but I do hope you also put it in your calendar to join us each week if it fits your schedule. If not, that's okay. You can also watch these sessions as an archive. Watch the recording just at your leisure. I'll show you how to do that in a little bit. I also want to let everybody know that that my very good friend Connie Hill is joining us out there in YouTube. Connie and I have now been working together for about 20 years. She's a great resource to have here. She's going to be addressing any questions that I can't get to just during the natural flow of the presentation. Thanks for having my back there, Connie. And you can follow Connie and me on X. If you have an account on X, you should be following your favorite presenters there. It's the very best place to connect with us in between these live streams. So you can find Connie on X at Connie Hill CS. You can find me there on X at Cameron May CS. But let's get into our discussion of options trading today, exploring this interesting strategy known as a synthetic stock. But as we have this discussion, of course, we need to bear in mind that there are risks associated with all of these strategies. So these are important disclosures. Options carry a high level of risk and are not suitable for all investors. The information here is for general informational purposes only. It should not be considered an individualized recommendation or endorsement of any particular security, chart pattern, or investment strategy. Investing involves risks, including the loss of principal. Short options can be assigned at any time up to expiration, regardless of the in-the-money amount, and any investment decision you make in your self-directed account is solely your responsibility. Okay. So let's set the agenda for what we want to discuss today. As I mentioned, we're doing a viewer request today, talking all about this thing known as a synthetic stock position. If you haven't heard of it, it's a trade that some options traders will use to mimic stock ownership. I'll talk about why they might do that, how it actually does a very good job of mimicking stock ownership. It comes up a little bit short in some places. So I'm going to talk about how a synthetic stock position is constructed, when it might be used, and we'll actually place a trade after discussing weighing the pros and the cons of the strategy. All right. So let's go right to, we're going to be using the thinkorswim desktop trading software platform. If you don't have this software, it can be downloaded free of charge from within your Schwab Online account. As I go to it, I'll just quickly tell you how to find this in your Schwab Online account. Just log in. You'll just go up to the Trade tab and then look for Thinkorswim. That's the name of the software. You can just download it and then log in using your Schwab user ID and password. No special different user ID or password needed. Same login. But it will connect to your live accounts, or will also connect to a simulated trading environment known as paper money. And that's where we find ourselves today. If you'll notice up here, it says simulated trading. This is a great tool to use if we're learning new strategies, if we want to explore something without having any real skin in the game, no real risk exposure, this is where we might want to do it. All right. So that's one of the great advantages of this thinkorswim software. In any case, let's get into this discussion. And I want to set the backdrop with a quick review of what's going on with the S&P 500 today, because the discussion that we're having today is about a strategy that is bullish in nature. It's a strategy that does well if stocks go up. It does poorly if stocks go down. So let's see what's going on with stocks. And yes, it's a down day for stocks. The S&P is down about 1.5%. I took a peek at some of the headlines that seems to be related to possibly some new hesitation about investors maybe losing a little bit of confidence in just how far this new AI technology is going to advance corporate profits and revenues. That's a story yet to be told, obviously. There's also, as a lot of us are aware, some concerns about interest rates maybe not being cut. There's a bit of a tug of war between the Fed and the executive office, sort of expansionary policies in place by the executive office. And if that leads to a rapidly expanding economy, cutting rates may add a little bit of heat to that fire. We'll see. We'll see what happens there. Whatever is causing the markets to retrace today, though, we are down about 1.5%. And so for a chart user, they may look at today's activity and say, could be the start of an extended downward move. But right now, we really find ourselves only trading about 2% below all-time highs. Greg says, so could this be a good strategy on a pullback? It could be, Greg. Now, obviously, it's going to depend on what the stock the trader selects, what it actually does after the trade is entered. And by no means is this a promotion for a specific strategy. In this webcast series, we just explore different strategies. We weigh the pros and the cons so traders can make informed decisions about whether it will ever play a role in their portfolios. But I'm just an educator. I'm not an advisor. All right. So anyway, yeah, we've pulled back. And for some technically oriented traders or investors, they may note that stocks do pull back even in great bullish runs like we've seen since April. And maybe it's their personal conviction that this pullback is just proportionate to very recent pullbacks, and it's kind of brought us down to kind of an intermediate term trend line. Do you notice that? Kind of pulled back, maybe bouncing along what we might call a price floor or a support. So let's say that our trader's conviction, our investor's conviction is that despite this kind of a rough day the S&P is having, maybe this is a potential entry opportunity for stocks that may settle at floors and start to advance from here. Don't know for sure that that's what's going to happen, but let's just say that's the premise of our trader today. So they're looking at maybe going out and buying stocks, or they have a stroke of genius, and instead of buying stocks, they're going to use an option strategy in place of stock purchasing. And I'll tell you that the primary premise, the thing that tends to attract a lot of options traders to this strategy we're discussing today is the comparatively lower cash requirement. It's going to deliver leverage to the trader. So here's how this is constructed. Go ahead, chat in, let me know. Just a quick yes or no. Are you familiar with this option strategy known as a synthetic stock or not? There's no shame in saying no, because nobody knows everything about the markets. Everybody had to learn this strategy at some point and then decide whether it's going to play a role in their portfolio or not. But just chat in a quick yes or no as I go to an example stock. And today's example stock is going to be Amazon. Amazon's having a very similar day to what the rest of the markets are doing. Okay, so I'm seeing a lot of no's. Not familiar with it at all, says somebody. Yeah, okay. A lot of people saying no. So let's make sure we are very explicit in what this trader is considering getting themselves into. They know, yes, the advantages, but also the risks. But just to bottom line it, what we're trying to do is create an option strategy that's going to behave almost identically to stock ownership. All right. So let's say that we have a trader who's interested in Amazon. Amazon's had a down day, just like so many stocks out there, but also it's kind of brought Amazon down to an upward sloping trend line, possibly what we'd call a support area, price floor. It's also pretty close to floors that we've seen over the course of the last month, just within a couple of dollars. So yeah, it might take a day or two to settle out, but let's say that our trader thinks Amazon's going to find a floor here and maybe go up toward where ceilings have been in recent history. So maybe they think it's going to go back up here around $235-ish. So hey, if the stock's at 222-ish, and the trader thinks it's going to go up to 235-ish, well, that's about $13 of profit potential if the stock goes that way. So the trader decides, all right, let me buy some shares. Well, 100 shares of Amazon is going to be about a $22,000 investment at this moment. And maybe the trader now thinks, wait a minute, I thought Coach Cam was talking about some strategy recently that's called a synthetic stock. What is a synthetic stock? Well, synthetic, doesn't that mean fake? Well, it's a different form of something. You can a synthetic, I don't have a great example, synthetic, whatever. Go ahead and chat in some synthetic examples of other things, but yeah, it just means a surrogate, sort of a fake version. Fake's a strong word. It implies bad. This isn't necessarily a bad strategy, but it has pros and cons. So here's what it begins with. Typically with an option trader, if they're bullish on a stock, they might consider buying a long call option. By the way, I'm sure some of you are saying, Cameron, why did you choose Amazon? Well, number one was what appeared to be happening on the chart looked pretty similar to maybe our trader's conviction with what's happening with the rest of stocks out there. So yeah, that played a role. But also for a lot of options traders, they emphasize price per share because that's going to be strongly correlated with the size of the risks that we're taking, but also the liquidity of stocks. Illiquid stocks tend to have illiquid options, which can create all kinds of issues with their pricing and make them hard to trade profitably. And options already carry enough risk as it is without having to layer on liquidity concern. So Amazon, yep, it was chosen. It's not a terribly expensive stock in the grand scheme of things. It is, however, one of the most liquid stocks on the planet, and it looked like its chart was behaving similarly to the premise that we already established. All right, synthetic motor oil. There we go. Yeah, synthetic leather, David. Great. Exactly. Yeah. It's a related but different version of something. It's intended to act like something, right? That's what we're going to be doing with our option strategy today. So today's trade, our example strategy. If I could just type today. I never can type very well. Anyway, our example strategy is a synthetic stock, right? And it does begin with, conceptually, with buying a long call. So let's go to our trade tab on Thinkorswim. We go to the trade tab, and this is where we can see the available options down here. So we just want to make sure that we've put in the correct symbol in the symbol box. So we're getting the options for that symbol. And let's say that our trader thinks, the way that Amazon is behaving, maybe it's going to run up for a month or two. Could go to 236-ish, 235, 236. Could it go higher? Absolutely. Now, could it also break down? Definitely could. Yep. In any case, CS says, y'all have fat fingers following a long weekend. Yeah, there's that, but I also can just blame it on I never learned how to type properly. Anyway, but a synthetic stock ownership begins with buying a long call. So let's go to our trade tab, and we're going to be talking about getting into some contracts here. If you're not familiar with options, it's a contract between two traders where they may be in the future exchanging shares of stock at a fixed price. So I'm going to look at these contracts that expire in 80 days. That's going to give us enough time to see if the stock goes where we think it's going to go. That's going to be through the 21st of November. So let's open up that 21st of November chain of options. And with the stock trading at 223 bucks, let's go down maybe to 225. Maybe that's where we're going to strike our deal. So you'll notice this column in the middle, strike. This is where we might strike a deal to exchange shares of stock with another trader. And let's first of all look at this through the lens of just buying a call option. So what if we were to buy the 21st of November 225 call? Not CAC, but call. It looks like that's trading. The 225 call is trading between $12.85 and $13. Let's just call it $12.90. I'll try to use round numbers here as much as possible. Just keep the math as straightforward as possible and keep the learning on the concept. Noodlebrain says, so it's similar leaps? No, Noodlebrain says can be constructed using leaps or long-term equity anticipation securities. Guys, that just means a long-term contract. The trader can choose the length of the time frame on the contracts. We could do an example here, anywhere from, boy, what is Amazon offering? Contracts for just 3 days, so we better get a quick move or we're just not going to have much of a window opportunity, all the way out to, we could get into deals that go out for 836 days. I'm just going to go for this $80-day example because it provides a large enough window for this trader who has this premise to see if we can get the stock to go up, maybe up to that price ceiling. We'll see. But let's stick with this 80-day contract. And we could just do this. Isn't this a form of a synthetic stock? Our trader could just buy the shares of stock, or in this case, what we've done is we're paying $12.90 per share on 100 shares. That would be a $1,290 investment. And for the next 80 days, we haven't purchased the stock, but we would have the right to purchase the stock for $225. That's our long call option. We just bought this right. So that's a form of a synthetic stock, but not a very good one. Sandeep says, which tool are you using? So Sandeep, I mentioned a little bit earlier, this is known as Thinkorswim, can be downloaded, software that can be downloaded free of charge from within your Schwab Online account. Okay. But in any case, notice I'm choosing the strike price that's just closest to the current price of the stock. So with the stock at 223, the closest strike price was 225. So I'm going with what we call the at the money strike. So I now know if I pay this $1,290, I have the right to buy 100 shares of Amazon at any time for the next 80 days for $225. So if those shares blast off, wow, if it goes to 230, 250, 300, 500, 900, obviously I'm exaggerating for the purpose of the learning, but I have the contractual right to buy shares for $225. And for that right, I've paid $12.90 per share. That's the deal. Now, for some traders, they may call that's close enough to stock ownership. It sort of simulates stock ownership, but it falls short in a couple of ways. And there are some disadvantages of doing this that some traders aren't terribly happy with. Number one is the expense of it, $1,290 to do this deal. Number two is the fact that it doesn't actually mimic stock ownership very well. We can actually measure that. Let's go down here. Our 225 that we looked at purchasing. Ooh, look at that. It went up in price. So the trader would already be a little bit profitable, unrealized gain at this moment. But I want to look at this delta. And Ambrose is saying, why not buy in the money? We could, Ambrose. As a matter of fact, it would create a very similar strategy. Strike selection, it's going to be up to the trader. I want to spend really the bulk of our time just discussing the strategy itself. Then we can experiment, maybe in future webcasts, with getting fancier, with choosing different strike prices and doing comparisons. Nathan says, I thought on a synthetic stock, it had to be deep in the money. Nope, doesn't have to be, not at all, no. But, and you'll see that in just a moment. Here's one of the shortcomings of just buying the stock or buying the long call. That 225, if the stock goes up $1, we have the right to buy the shares. Now that right is getting more valuable. But if we look at our delta, one of the things that delta can tell us is how much our option gains or loses in value on a $1 move on the stock price. So if the stock goes up $1, the shareholders of that stock now have an unrealized gain of $1. How much would our option trader have in an unrealized gain? Not $1. It'd have 54 cents. It's not a dollar for dollar synthetic version of the stock ownership. So this is a shortcoming of owning just the long call. Now, another thing is the time decay. We know that we have 80 days for this stock to get up and go and do something. And each day where it doesn't move, the value of our option loses. We just lose value. That's the time decay. And we can measure that using our theta. That's our T. Theta starts with T, so does time. That's our exposure to time decay. So if we buy this call option and the stock doesn't budge, and the only thing that happens is 24 hours goes by, we might be sitting on a 9 cent or a $9 unrealized loss. So there are a few shortcomings where just buying a long call doesn't do a very good job of acting as a stand-in for stock ownership. It doesn't provide dollar for dollar return potential. It has time decay. And then the final thing is, it has, for some traders, a spooky amount of leverage. Because let's look at this. If we spent $12, you can already see that leverage working in the favor of the trader, but could have just as easily gone the opposite direction. We were talking about buying this thing for $12.90 just a few minutes ago. This thing is now trading for closer to $13.20. That's already changed about 30 cents in value in a few minutes. That's about 3% of this initial investment we were just discussing. Making possibly 3% over the course of a few minutes, or losing 3% over the course of a few minutes. Hey, if the trader's great, trader's great with their timing, that leverage can really pay off. If their timing is no good and the stock goes the wrong direction, that leverage can really hurt. And as a matter of fact, a single $1 move on our stock could cause a 54-cent gain or a 54-cent loss on our $12.90 investment. Just $1 move on this $223 stock. Irfan says, will you repeat this session? I won't repeat it, but it will be added. It is scheduled to be added to our archives. Let me do this. Let me put a link in the chat window. There we go. There is the playlist for this YouTube series. You can go back and watch this. So let's make this a much closer version to synthetic stock ownership, to actual stock ownership. And so this is how the rest of the trade is accomplished. At the same time we buy a call, we sell a put at the same strike. Okay, that's it. So we're also going to sell the 21st of November. We don't even have to go to a different expiration. Don't go to a different strike. Same month, same strike. Just move to the other side. We're going to sell the 21st of November put. And that is trading for right now between 1240 and 1250. We'll call it 1245. Okay. So we're spending 1290 to buy the call. We're collecting, and this might be a little bit more now. So it might be a few pennies more here. But we're collecting 1245 to sell the put. What did that just do to the net expense of the trade? It almost eliminated it. In some cases, we're not paying much at all. Other cases, it may actually generate a small credit. Now, don't get confused. Just because we're not paying very much, or even if we receive a credit, doesn't mean the trader is often running with a profit or a loss. This actually still has plenty of potential, and it still has plenty of risk, whether it starts off with a small debit or a small credit. That's not consequential, really, to the ultimate outcome of the trade. Ultimate outcome of the trade comes down to what does the stock do next. So what does this put do for us? Number one, yes, it does reduce the risk. Another, not the risk, sorry, the net investment in the trade. Now, another thing it does, though, is it slows down that time decay. We were looking at this long call, and if 24 hours went by and the stock didn't do anything, we were looking at a 9-cent per share unrealized loss, or $9. Well, if we look at the puts and we look at our theta, well, we're not buying this, we're selling it. So that's going to bring in a positive 7 cents. I want to do a breakdown here to show how this actually mimics stock ownership quite closely. We have our delta, and I know some of you might not be terribly familiar with the Greeks. I have a good suggestion for you there because they are vital to really understanding how to trade options. We have delta, we have theta, and we have vega. I really wanted to discuss this. But as we do, I'm going to make you aware of some resources you have outside of these live discussions. All right? We do live streams, but we record them, the vast majority of those, and we put them into playlists on our YouTube channel. So number one, if you haven't subscribed to our YouTube channel yet, make sure you do that right now. Go down in the lower right-hand corner, click on the subscribe button, or go down below the video stream, click on that subscribe button if you haven't done that already. It doesn't cost anything. It literally only takes a second to do it. but that subscribes you to our YouTube channel. And this is where we house all of our playlists of previous webcasts. You can join our live streams here as well, and you can do searches for topics of specific interest. But there's the full name of our channel. You can just look it up on YouTube, Trader Talks Schwab Coaching Webcasts. And when you're here, you could do something like this. Hey, you know what? Cameron's talking about the Greeks. I don't know a lot about the Greeks. Let me type in Greeks, not Greeks, but Greeks. And hey, there's Brent, A Beginner's Guide to Option Greeks. Or right here's the one that I was going to recommend because I'm the one that taught it and I know exactly what I said. Understanding the vital role of the Greeks in options pricing and trading. That's a big one. All right. I see that positive pressure. You subscribed. Thank you for doing that. I think you just did yourself a favor. But let's go back to our trade. And I want to show you in real-time numbers how this very closely mimics stock performance. It stops behaving like an option and starts behaving like a stock. Okay. Well, the first thing I want to look at is delta. Delta is how much the trade can make or lose on a $1 move on the stock. Well, if we just bought the call, it has a delta of plus 54. What that means is if the stock goes up $1, our call would make $1. Would make 54 cents, sorry. If the stock were to go down $1, our call would lose 54 cents. Now, there are other variables at play, Beta and Vega, but just looking at this from price movement, we're getting sort of partial performance. It's kind of behaving like a stock, but not completely. Now, if we go over to the put, what's our delta over here? It's 47 cents. It says minus. Yeah. If we were to buy that put and the stock were to go up $1, we could lose 47 cents. We're not buying that put. We are selling that put. So instead of a minus, this is going to be another plus another 47 cents. Do the math for me. 54 cents from our call plus 47 cents from our put. Isn't that right on $1? Almost exactly $1. So what this is telling us is between the call that we bought, which is a bullish strategy, and the put that we sold, which is a bullish strategy, well, if the stock goes up $1, this trade makes $1 in unrealized profit. Now, if the stock goes down $1, our bullish call loses 54 cents, our bullish put loses 47 cents, and we lose $1. So, yep, it's behaving just like stock ownership. Now, Ambrose says, what about time decay? Well, what's our theta of our call that we bought? It's a minus 9 cents. Right? But over on the put side of things, it has a minus 7. If we were buying that put and a day goes by, we'd be losing money on our call. We'd be losing money on our put. But when we sell options, time works in favor of that trade. And that would be a positive 7 cents. So actually it would be 9 cents, but plus 7 cents. We have almost eliminated, not completely eliminated, but dramatically reduced the impact of time decay. Better put a minus in there. It's still negative, but it's just, now B Vice says, is this like a vertical call? No, it's not. It's a combination of a long option and a short option. So in that way, it's similar-ish. It's a multi-leg strategy, but no, it's actually a better way to describe it is it's a synthetic stock position. It behaves essentially like a stock. So is time decay still a factor? Yes. Is it nearly the factor that it is if we were to just buy the call option? No. All right, now finally, what about our Vega? A Vega starts with V. That's our exposure to rising and falling levels of volatility. If you're not familiar with Vega, that's what it is. As stocks get more volatile, the options typically get more expensive. As stocks get less volatile, the options get less expensive. And so that can have an impact on the value of a contract that we're currently in. Well, let's look at our Vega. Our 225 Vega is 42 cents for the call that we bought. Over here on the put that we're selling, well, we're selling that, we're going to have to put a minus sign next to it. When we're selling options, we just invert whatever is displayed here. So if it's a negative, we change it to a positive. If it's a positive, we change it to a negative. So we have a positive impact from Vega on our call, but a negative impact from Vega or changing volatility levels on our put. What's the impact of changing volatility levels overall? I'm going to put in my other zero here just to be grammatically consistent here. Vega is no longer playing much of a role at all. So you look at this and tell me, is the trader concerned about volatility? Are they concerned about time, or are they concerned about price direction? Yeah, this is behaving almost exactly like stock ownership. If the stock goes up $1, we make $1. If the stock goes down $1, we lose $1. Time's hardly playing a role. Volatility's hardly playing a role. So, Janet, you just asked a very good question, and we need to discuss that. Janet just says, can we do this in our cash account, or do we need margin? We do need options approval. But I want to compare a margin account to an IRA account, because there can be theoretical advantages for a trader in a margin account. Those advantages evaporate when we move over to a cash or an IRA account. They really don't exist. So that's a great question. All right, so one of the qualifiers for this strategy for a trader to consider is probably they want to be doing it if it's their habit to be trading in a margin account. An IRA account, there's not really an advantage that I'm aware of to this strategy. All right, but yeah, can we now say that, oh, this really is a pretty good version of it? It behaves very much like a stock. Yeah, for the next 80 days, time not playing much of a role. For the next 80 days, we don't really have to pay much attention to what's going on with volatility levels. Instead, it all comes down to which way is the stock going. Actually, the stock's going in the right direction already. We had a red candle when we started this discussion. It's already moved to white. So it's going in the right direction. And that's what our trader is hoping for. Now, there are definitely, even though this is now behaving essentially dollar for dollar, just like a stock, it does come up short in the true comparison. Just like somebody mentioned, a leather jacket versus a vinyl jacket. Yeah, looks like leather, kind of feels like leather, not leather, right? This looks like stock, behaves like stock, not stock. What are some important ways that this is not like stock ownership? Well, number one, there are no dividends. We don't own the stock, so we don't have claim on dividends. Number two, we don't own the stock. The trader does not have voting rights. Number three, when we own the stock, we can hold on to that stock as long as we want to. With this trade, we have 80 days. So it's either going to work or it's not within the time frame of the contracts. And it can have some exposure to time decay. Sometimes there's virtually no exposure. In this case, there's a little bit. So it's not exactly the same. Now, let's see. John's asking a good question. What about tax implications in a cash account versus an IRA account? John, you've asked a really good question. One thing I am certainly not. I mentioned earlier, I'm not an advisor. I am definitely not a licensed tax preparer. So am I familiar with the tax implications of the strategy? I actually am. I can have a very good conversation with you about that, but it would be inappropriate. I don't know your scenario. So talk with your licensed tax professional. So how is the trade constructed? Well, buy a call, sell a put at the same strike, same expiration at the same moment. And what you're going to wind up with is this. Whether we do that deeply in the money, whether we do that far out of the money, look what happens to our Greeks as we change this. Even if we were to buy, like, let's just choose a different strike, 200. Hey, we have a delta of 80 plus a delta of 20. Isn't that $1? We have theta of -8 cents and 6 cents. So the net between that, isn't that 2 cents? And our Vega at that 200 level is 29 cents here. It's 29 cents there. That's a wash. Isn't that exactly the same trade? It's really just, is strike selection the biggest deal here? Nope. I just went with the at the money strike. Each one of these, in the money, out of the money, whatever, is going to behave very much like the stock, right? It's all going to result in a synthetic stock position. Now, what we have to keep a keen eye out for is what happens to at expiration if we just let this go all the way, all 80 days, or if we get assigned early. Now, if we go further in the money or out of the money, that's tough to say in or out of the money because one's going deeper in the money, the other one's going further out of the money. As the one that's going deeper in the money, there is a possibility of assignment risk. Yep, you have to be aware of that. But in any case, let's go with our at the money strike, and let's talk about managing profits and losses. And really, since this is behaving very much like stock ownership, we would just treat it like a stock trade, basically. So whatever motivates the trader to get into their stock trade might be the same motivation to get out of that trade until the expiration of these contracts. So if the stock starts to go up and maybe we get up to a price target, that could be the reason to take the profits. If the stock falls down, starts breaking below price floors, maybe we would just want to take our losses. So how about for our trader here? Let's say they'd be happy if they could get out of the trade at 225, or pardon me, at 235. But if we fell down below 220, if we started to break down below this price floor, let's say we get down to 219, maybe the trader is thinking, hey, you know what, this trend isn't working out. The price floor isn't holding. Let's just get out of this trade. Let me show you how to place this trade with both of those outcomes in place, okay? So I'm going to go to the Trade tab. And a quick way to place this trade is to come up here where it says Spread Single. It's showing us all the single strikes. We can choose strategies here. And I'm going to choose the synthetic strategy. So I'll choose synthetic. And now you'll notice it says 225 and 225. And I can just go either to the calls or the puts. It doesn't matter which. But I'm just going to click on the ask price to create a buy order. And that's going to put in an order to buy actually 10 contracts, maybe mimicking 1,000 shares. Let's dial this just down to one contract. And I want to do a comparison here. Okay. Before we go in and place the orders to take profits or to take losses, let's just remind ourselves, if we bought 100 shares of Amazon, right now that would cost us $22,400, almost on the nose. If we were going to fill at current prices, $22,400. Well, if I'm doing this trade in our example margin account, let's direct this to our margin account, and I click confirm and send. How much cash is it tying up? Not $22,400, but $5,800. My math says that's about 25% of the amount of cash is required to get this trade in action versus buying the stock. So then if I put in a quarter the amount of the money, but I stand to make 100% as much money as stock ownership, I'm getting 4 times the potential return. That's a lot of leverage. 4 times the potential return. Now, obviously, if the stock goes the wrong direction, what happens? We lose money 4 times as fast. This is a strategy that can work in either direction. Leverage is a potential advantage for those traders who feel quite confident in their timing. It's definitely a potential risk if it goes the wrong direction. Now, CS says it's kind of less than a quarter. I did some rounding there, right? Yeah. It's going to be a little bit more, $5,800 times 4 is going to put us a little bit above 220 or 22,400, but close enough, right? What if I were to put this in my IRA? Let's see how much money that ties up. Because I said in an IRA, the advantages kind of disappear. Let's switch this over, route this to the IRA. And it says, Cameron, nope. With this strategy, you can lose dollar for dollar along with the stock. And it's possible that within the next 80 days, it's not likely, but it's possible that Amazon could go to zero and you could lose all those dollars. And you better make sure you have every one of those dollars in your IRA so you can cover that potential loss. It's going to require every penny of a potential loss plus whatever you might have paid for the trade. So yeah, notice we just went from 22,400 to 22,600 to do that trade. Yeah, in an IRA, bye-bye advantage. There's not really an advantage to doing this strategy in an IRA. But within a margin account, for some traders who are seeking leverage, they're comfortable with leverage, and they want dollar to dollar potential returns with very little exposure to time decay, this is the strategy that they might go to, or one of those strategies they might consider. All right, so that is an important part of this discussion. But now, before we submit that order, let's put in a plan to take our profits up there at 235, or maybe take losses down at 219-ish. So here's how we might do that on Thinkorswim. Instead of just putting in a single order, I'm going to change this to what's called a first triggers OCO. That allows us to put in an entry order and two exit orders. So now I just need to create those two exit orders. And I do that by right-clicking on the entry order and creating opposite orders. Right-click, opposite order. So here are our two exit orders. Well, these, we wanted to close under certain conditions, price conditions. And over to the far right of these exit orders, there's a little gear. I'm going to click on that gear, and it brings up this pop-up. And this is telling us, this is where we tell the system what we want to have happen and when we want to have it happen. So we want to sell out of this synthetic stock position at a future market value. I'm going to make that good till canceled. And specifically, we want to sell out if the market value of Amazon goes above 235. So if you're not familiar with this conditional order, we put in our condition here. Amazon market price, let's put in greater than or equal to, not less than or equal to, greater than or equal to $235. If it gets there, we want to sell this synthetic stock position at the market price or whatever it is at that point. So I'm going to save that. And then the other one, I'm just going to enter an opposite condition. Let's sell at a future market price, good till canceled. If Amazon market value falls to less than or equal to $15. Getting a little bit fancy today. The nice thing is these sessions are recorded. The vast majority of them are added to our YouTube channel after the webcast is over. So let's click save. There we go. So let's now click confirm and send. And we're going to buy, it's calling this a combo, but we know it's a combination of options creating something known as a synthetic stock position. So we're going to buy it right now. If the stock rises up to 235, we're going to close it out. And having gone from, where are we right at the moment? 224. If we go from 224 to 235, we should have a dollar for dollar return, about $11. If the, and that would be $1,100 on the $5,800 that we've tied up. If the stock falls down to 219, that would be about a $5 loss, about $500 lost of our $5,800 that we've tied up. Okay, let's send this off. And that order is now in and working. All right. Now, here's the deal, guys. We think we've covered all of our bases. It's still possible that we don't get up there. We don't fall down to 219. If this is allowed to get to expiration, this will almost certainly result in stock ownership. Because if the call is in the money at expiration of the stock, okay, we're in that trade. If the stock is above 225 at expiration, our long call will be in the money, and it'll get exercised, and we own the shares. The put just expires worthless. If the stock is below 225, the put will be in the money. We'll be assigned those shares, still wind up owning shares. Our call expires worthless, and we wind up owning shares of stock. So we definitely need to pay attention. We put in orders to take profits or take losses if we get to 235 or down to 219, but we still have to pay attention. We might need to go in and cancel those orders and exit the trade manually if we haven't gotten there by expiration. Okay, Nathan says, what's the disadvantage of placing this trade in the IRA? Nathan, the disadvantage is there is no advantage over stock ownership. It ties up just as much money. Okay. But guys, we have accomplished what we set out to do today. A little bit heavier lifting than we typically might cover in this Getting Started with Options series. But somebody asked the question, Cameron, what is this synthetic stock position? What are the pros and the cons, and how might the trade be placed? So I just wanted to answer that viewer's question. Hope you enjoyed this discussion. If you need to revisit this, make sure that you just go to our YouTube channel, make sure that you're subscribed, and you'll find this webcast. Let me just go back to the channel homepage here. So number one, make sure you subscribe to our Trader Talks Schwab Coaching webcast channel, but you'll be able to find this webcast right here under playlists. If I went to playlists, scroll down basically to the bottom, mine is second row from the bottom, Getting Started with Options. There's that view full playlist. You can also join our live webcast here, and you can do keyword searches as we did earlier today. Now, another big suggestion that I have for everybody watching is if you have an account on the platform known as X, you should be following your favorite presenters there. It's the best place to connect with me in between these live streams. So for example, just this morning on X, I posted this question. Hey, with the S&P getting off to a weak start, do you think it's more likely to go up the rest of the week, finish close to these highs? Or is it more likely to go down the rest of the week, finish closer to these lows? And it's interesting to see people's feedback. If you reply to one of my tweets, I try to reply right back to you. I know it's called an X post, but you reply to one of my posts, I reply right back to you. Best place to connect with us is right there. All right, everybody, time for me to let you go. Lots still in store. Go enjoy the rest of our educational offerings for the rest of the day. I will see you all next Tuesday for another discussion of Getting Started with Options. I have other webcasts each day of the week, so I'd love to see you in those as well. But whenever I see you again, until that moment arrives, I want to wish you the very best of luck. Happy trading. Bye-bye.